The market is changing. Where is it going? Stay tuned. Well, welcome to this week's edition of NoteSchool TV. And, well, it's that time of the month when, we do the monthly update. So August of 2024 month end. So we'll get into that. Eddie and I will in just a minute. But before we do, make sure and hit that like button. Make sure and like this episode. This is a big one. Make sure and save it and ship it off to your friends, right? Share it with your friends, your associates, everybody that you know out there. You're really helping us out when you do that. And make sure and also, if you have not subscribed to the NoteSchool TV channel, make sure and do that as well. And then lastly, make sure and hit that bell notification. Yep, boom, hit that bell notification so that you will be notified every week right before we go live. When? Well, we go live every Wednesday at 11:05 Central Time. Make sure and keep those questions coming. We love hearing from you. We love hearing what you have to say about what's going on in your marketplace. And if you would like to know more about what we do at NoteSchool, just simply go to noteschool.com/TV. Again, noteschool.com/TV. With that, I want to bring on NoteSchool's founder, our chief visionary officer, all around good guy, Mr. Eddie Speed.
Good morning, Joe.
Good morning. Wow. Can you believe it? We're going to be in September here in just a few days.
I know it. We old people like us say this a lot, but it's kind of true, right? Time flies.
Time flies. Yeah. You don't get it, right? So until you do get a little older and a little gray hair, that's for sure.
Yeah. Live every day and enjoy every day, Joe.
That's it. And be appreciative of what you have, your family, and, take care of what you can take care of for sure.
That's right.
Yep.
All right. Well, you said it right. The market's changing. Do we say that too much? I don't know. I feel like that there are a lot of shifts in the market right now. And we've tried to gather up a lot of information to paint this picture. Joe, I'm going to tell you this. I have a very good friend who is associated at a national level in the mortgage related industry.
Right.
Very connected at a Wall Street level, very connected with some of the people that make $1 billion bets about the business, right? And I called him last week and I said, what in the world is going on? And he said, I don't know. He said, I just got back from Wall Street. And he said, there are so many opinions out there right now that we said, we're really in flux. And I said, well, I just want to make sure I wasn't misreading that. So I'm going to start this session, this monthly update with saying what we're reflecting to you and what these charts reflect, and everything we're saying is a reflection of what I think the biggest decision makers are trying to get a read on the market. And I don't know that they have a read on it. So we're just going to try to present the information. But we are, Joe, I think, in flux.
We are. It's like I said to you, I said, Eddie, there is so much information out there. You just, we got to get together for a few minutes. And we got to assimilate some of this and, do our best to figure out what's going on.
All right, let's get after it.
Let's get at it. All right. Housing market. All right. So, Eddie, according to the National Association of Realtors, and of course, these are the latest information, right? July of 24. Yeah. The seasonally adjusted rate of home sales, 3.95 million. Month over month is up. Yep. 1.3% as far as existing. We're talking about existing home sales, 2.5 year over year. And Eddie, looks like inventory is going up as far as month supply. We're up to 4%. We're up 4%. since from 3.3 to 4% from last July as well. And you see what the year-over-year median sales price is up 4.2, and that is on existing home sales.
Okay. Biggest thing about this chart is 4-month supply, and that number is moving long, and that's one of the reasons for the flux. So as we progress, I want you to know that we're paying attention to days on the market.
Yes. Yes, right. We are.
This is existing residential home sales.
That's right.
Right. This isn't builder. This is different.
That's right.
Okay.
So now we've got new residential home. We've got, we started out with the existing. Now we're looking at new home sales. And again, it's up, 10% year over year. New houses sold, 739,000. New houses for sale at 462. And you see that the new residential properties are up 422 on the existing to 429 on this on the new residential sales.
Which is very interesting, Joe, because that number's almost even on both sides.
It is.
And you would presume that new home sale builder homes, that tells you that the high-end builder homes has fallen out.
Yes.
Because that number is back down a lot.
It is. It is. And again, that's the on the closing statement, but what those builders are having to do to make that happen, well, that's another story, right?
That's it.
All right. All right. New residential sales. Eddie, again, you can see the chart here, and we're just right in here. That was the 739,000 that had sold, according to the Department of Housing and Urban Development. So Census Bureau. New residential sales.
All right. Big thing about this report, though, Joe, was talking about the fact that home builders are in flux.
Yes, they are.
Because they're having to pay all the buy downs on loans, and they're doing this and that. So their home sales are not surging the way that the perception is they should be surging.
Right.
And they're having to really manipulate things. By the way, days on market of new home sales is about 10 months.
Yeah, let's yeah.
So understand, new home sales days on the market is way longer than houses that are listed in MLS. Yes. Most home builder sales are not in MLS.
That's right.
Okay, so this is kind of almost two different markets, but it's pointing to the same buyer. And anyway, we just think that's interesting. I think the home builder concern is higher than people think.
Yeah, that sentiment level with the home builders is way down. They've got, more than 7.5 months of supply. That's a lot of supply. The cost to carry, they're having to insure those houses and pay taxes on them as well, Eddie, as well as then giving away, buying down rates and to make them affordable and to move that inventory. So yeah, there's a lot going on there.
All right, let's look at
this next slide. Eddie, I still love this. We showed this to these guys last month, but it's still so relevant. I mean, you look at that change. I mean, look at over here in Florida.
Use your red pencil, Joe.
Yeah, that's part of my dyslexia is getting from that yellow to red, right?
I like the red pencil because that way you could draw on a colored slide and you can see.
And so, guys, just understand that Eddie picks at me, on other presentations we do when I do that. Well, no, there's the yellow still. So anyway, 71%. Florida's the highest, man. We're seeing it happen.
Yeah.
And Eddie has a lot to do with condos as well.
This is a shift in housing inventory year over year. Texas, the hot states, Georgia, Carolinas.
Yeah.
Arizona's way up. I'm like, these are things that we told you we're watching. Now we're kind of coming forward with what that is.
Yeah.
So, all right. Okay, Joe, this slide here is important because this shows us the increase in inventory. What the previous map shows us, I want to highlight this in yellow, right? And when you see that, Joe, that is this year's increase in listings.
Yes.
And that increased all through the most selling months.
Yes.
Okay. So that shows us, Joe, we were at the mid 600s at the beginning of the year.
Right.
And we're now almost into 900,000. This is gigantic. And most people in the mortgage banking world and the loan servicing world, they're very much paying attention to this.
And Eddie, normally instead of seeing listings go up over the spring months, right, the April, May, and into the 1st of June, we would see that line, people would be buying homes, but it's certainly going the wrong way there.
Well, look at previous years.
Yeah. Yeah.
So understand we're in we are living in interesting times.
Yes.
Some of those colors that you see in there were we were trending exactly in a pretty opposite direction. So we're paying a lot of attention to the increase in listings and the days on the market. All right.
Okay. So Wolf Street from the Department of Commerce, inventory of completed houses surges to highest since 2009, triple from 2 years ago. And saying, is this exactly what's needed to bring down prices across the housing market? And, we look at this, and again, inventory is up. We look back here, we understand why back there inventory was way up, right? We had the Great Recession. And then we go over here and we're seeing that again, trending up as well. New completed houses.
All right. We're going back and forth a little bit, guys. We're going back and forth between existing home sales, which is MLS listings, and new home sales, which is predominantly not listed in MLS.
Right.
Okay. But we're trying to say it's all inventory, right? It's all together to some degree. And let me just tell you something. If you look at that trend line going up from 23 to 24, that last little surge, Joe, that's inventory in new homes available.
Yes. Yeah.
And so, like highlight that right about where that last surge going up all the way down, right down there to the bottom. Now go. And you can see it's going up.
Yep.
The math is there, right? So,
and Eddie, again, the important thing here is that existing houses, trend line is up 4 months supply. We were down to just almost a month and a half. And then we look at completed homes, new completed houses, and we're at 7.5 months plus supply on that as well.
Okay.
Let's talk about the banks. So, current rates as of a day or so ago, Eddie, we're at 800 plus score, 20% down, 35% or less debt to income ratio, blah blah blah. We're at 6.92 on the APR, and we see what the 15-year fixed and then the jumbo is. So
it's very interesting that we are seeing a little more favor in the 15-year fix than we've been seeing.
Yes, we have, because it's been nearly the same.
It has been almost the same, which has been really interesting.
Yeah.
So rates are down. This is this flux we're talking about.
Right.
Look,
let's look at this next. Yeah, next slide here, Eddie.
And in showing the trend lines and where we're at in the market. And once again, we were almost at 8%.
Yeah.
And that's the top line, though, Joe, just to be clear about that. This is the bottom line is what the bond market is.
Right.
The darker blue line is the bond market. And if you don't believe that mortgage rates trend with the bond market, look at that tracking.
Mm-hmm.
I mean, it's not exactly a twin sister, but it ain't far from it.
No, you're right.
Right. So that's why when people get all amped up about the Fed rates and we're like, yeah, but that's not really mortgage rates.
Yeah, that's right.
The 10-year bond market is usually what we're paying attention to, and you can see why.
Yeah.
So we're trending down in rates, but the market is not reacting to it, Joe.
That's it. And that's, you know, and the key here is, you know, the tipping point. Everybody says, well, if the rates were at 5.25, boy, the floodgates would bust open and here we go. But homes will be just as expensive. That's the thing.
Yeah, the price increase and rate increase, but everybody blamed it all on rates. And I believe that we've said all along, it's the jump in price that's made the affordability the problem.
Exactly.
And so, you know, there we go.
Well, we had the two things that had really never really happened, right? We had rates going up and prices going up at the same time.
Yeah.
Yeah. All right, let's look at the number of mortgage applications. And Eddie, well, we look at that yellow line across there, and obviously you can't see me why, but you look at this, right? I mean, there it is. And here, this tells the story, 13% down year over year and 50% from pre-pandemic norms. Eddie, we used to talk about 2 years ago, you know, the mortgage originations were $4.8 trillion, and then they chunked down about 30% and ended up about $2.2 trillion. Yeah.
Mortgage rates our mortgage loan production is excessively down. And we're watching it. We're not. Listen, I tell people all the time, like, rates dropping is good for our industry.
Oh, absolutely. Right? Good for
and they say, well, but if rates drop, we're not going to be able to buy all the notes we're going to be able to buy. That's not true.
Not true.
There's nothing we see in front of us that's going to change the note inventory that we already know is in front of us.
Right.
And so we want rates to drop because it's good for the business.
It is, and it's something that you said yesterday, and that was the fact that, you know, it's the availability of money to go out and buy. It's not so much the rate. If it doesn't matter what the rate is, if you can't get it, right?
Rates dropping is not going to change the situation with commercial banks.
Yes,
and their commercial loan inventory, which is very distressed.
Yeah.
And so that's what's driving the inventory of notes that we're seeing. It's not us having a tug of war with rates and us, oh, we don't want rates to go down because we're buying more discounted notes. No, actually, we don't see that changing the inventory of discounted notes. And we think rates dropping are good for the economy and good for our friends that are borrowing money.
There you go.
Less cost of money.
Let's do it. Yeah. And so we looked at new mortgage app. These are refinance originations, Eddie. And well, you can see here that, well, again, we go back to that benchmark there in during the pandemic, and we're up nearly 1.2 trillion in refinance. And then, we're back down here. And now we're about $62 trillion or $62 billion in refinance. So not really and this is at a time when homeowners have more equity than they've ever had.
It's just sticker shock. It's rates.
It is. Yeah.
Yep.
So let's look at, and again, we talked about the availability of credit there. And, it ticks it. Last month, it was 95. This month, it's 95.6, a very small change. But again, we go back to, over here where it was, and then that crazy drop. And then, it continued to drop.
Yeah.
Yeah.
No, it's mortgage lending is as tight as it's been since, you can see the map there. It's as tight as it's been since 2012.
Yeah.
And that was really tight back then. And
it went from where everybody could get a loan to, well, almost.
And back in 2007, it was like 800. It was at 185.
Yeah.
It was at 185 before the virus, and now we're at 95. So about 50% of the people, and that's what's creating the opportunity in the seller finance world.
That's it.
It really is not rates. It's really credit underwriting. So
that's it.
All right.
Well, here he is. Here's our friend, your friend and mine. The time has come to lower rates. Chairman Powell has said so. Financial markets are rallying. It's time to start cutting rates from the and again, when we're talking about this 5.3 level, we're talking about the federal funds rate, right? We're not talking about mortgage interest rate. We're talking about the federal funds rate.
So we're going to see the Fed rates drop. I think there's a lot of anticipation about when and how much. And so we'll see.
It scares me, Eddie, that if it drops too quickly, is that going to cause housing prices to go up even more? Because then everybody's scrambling for. I don't know. But there's plenty of inventory, so it's just a dichotomy of what's going on out there. So.
All right. Well, you got a projection here.
Yep. Let's look at that.
Somebody throwing it out there, and they're saying this is what they think is going to happen.
Yeah, here and again, this is the Fed funds rate. This isn't interest rates. This is what banks loan each other, but the Fed loans banks money on overnight funds rate. So you've got the federal funds rate, Eddie. Then you've got the 10-year T-bill, which is what really mortgage rates are based on. And then you've got the real mortgage interest rate, right?
Mm-hmm. So here's the bottom line. This is a pretty aggressive chart showing what they think the Fed funds are going to do. And Joe, I would say to think that they're going to drop a full 100 basis points, and listen,
in 4 months, 3 months,
it seems aggressive.
It does,
right? I don't want to shake my head and say that's impossible, but it seems aggressive.
Well, and with everything that's going on around us and so on, yeah, it does seem a little much. So we'll see how that plays out. Again, no crystal ball, right? The rearview mirror. That's an Eddieism. All right, let's talk about folks piling up cash. So we've got our friend Warren Buffett. His cash pile, Eddie's hit $277 billion.
Yeah. So here's the thing. The reason he's sitting on cash is he doesn't know what to invest in.
There you go.
And we would say that we see a lot of people sitting on cash, and they found out that they can buy performing notes right now. And that makes 10 times more sense than the other real estate related investments that they're making. Right. Commercial real estate has got obviously issues, which we're going to cover. Rent houses are not cash flowing well. And so this is why people are coming into our market. And when we look at the biggest money in the business and all the cash situation, it all makes sense. Like Warren Buffett. Where are we at kind of everybody, Joe?
Well, this is a big number right here. That's $6.440 trillion. So we're not talking about businesses. We're talking about individual money market accounts. People are sitting on, $6.4 trillion.
So you can look at when the markets start getting weird, how the cash position starts shooting up.
Yep.
Right. And that's because people don't know what to invest in. Go to not so quite far back, Joe. Not all that line.
Right.
Go to like about 23 when it just has that last little surge in it.
Right.
That shows you that was when the market started getting weird.
Yep. And people were like, again, they're like, okay, what do we do? Well, let's just put it in let's just put it under the mattress, so to speak.
So this is why we see people coming to the note space.
That's it.
All right.
They want a predictable monthly income, passive monthly income. So Eddie, the Psalm rule, Charlie Psalm, he says we're already in a recession, right? And I think a lot of people would probably agree. We just looked at the employment numbers. They're not looking great and so on. So if we look at, where this was saying, hey, everything was rocking and rolling, to this bottom number, that's a big drop. And again, we can see how it increased here. This was kind of as we were in the Great Recession, the 2010, 2012 area. And so,
Well, I think this is that part of that flux, right?
Yeah.
I think whatever your political persuasion is has a lot to do with what you're calling that right now.
Yeah, absolutely. So, yep, that's again, we're as you said, Eddie, we're calling the ball here's the information. Take it and go move forward accordingly, right? So this is the year over year change in the consumer price index. And, we look and say, okay, well, what, this shows down, right? But again, what is it down from here, Eddie? It's down from a previous high.
Mm-hmm.
Yeah.
Or from 22.
Yeah, from 22. Yeah, from 22 to 24.
So yeah, the blue line, which is this year,
right,
is just not as quite as extreme, except for transportation.
Yeah,
and shelter. That it isn't quite as extreme as it was when things were going wild, but it's not like the grocery store trip doesn't cost less.
Yeah, no,
it's just not increasing quite as much.
Right.
All right.
And the next few months there'll be some interesting games being played here. So this is potential. This is in the commercial, right, multifamily investor space. So I thought this was interesting because this is more of a forecast, right? Here we are in 2024. And Eddie, we look at the bank exposure in multifamily loans, which is, here, right? And look how that will change over the next, 6-7 years. So banks are pretty exposed. The debt funds, securitized, very small piece of the pie. Insurance companies, of course, play big in that space. And then the GSE coverage. But look at how we go from here with the GSE coverage. And again, these are projections, but look over here where that GSE, where the taxpayers are backstopping that.
Well, bottom line is these are trouble loans that are over 80% loan to value. And this next 3 years, and listen, in late 22, we were calling the ball. There was a big problem in multifamily. And there's a lot of people thought we were crazy. What are you talking about? And we were just looking forward at all the information and all the things that were leading to that. And this shows us that the next 3 years in multifamily are going to be not good.
Right.
And we got multiple other things that support this.
Yeah.
And if that's not your belief system, then okay, we're sorry.
Right. If you're multi,
okay, we're not going to hurt your feelings.
We're not here to do that, okay?
But let me just tell you something. If you're drinking the Kool-Aid like multifamily is hot and on fire and we're crushing it and that's everything, no, there's no data out there that supports that position.
Yeah, for sure. Change in effective asking rents on new leases year over year.
I think that's almost flat, Joe. You can call that one flat.
Yeah, we go to here, then we go to here, and it's just that's not a good trend, right? So, and then again, we see we've Austin is, and these 5 cities, 16.9% in Austin. I mean, we talked about this, not this particular, that wasn't that severe a couple months ago. We were talking about this, but those are big drops in some markets that were crazy appreciating in back a couple years ago.
Listen, I was at an event 3 months ago and heard a multifamily guy in Austin talking about how hot the market was.
Yeah.
And how the rents were trending in the great direct. I'm like, whoa, Austin, Texas? Or are we talking about Australia?
Yeah.
Because I thought we were talking about something else.
Yeah.
Yeah. So we are, the market is getting a lot of press right now. And there's 2 reasons that I'm interested in multifamily. Money moving from multifamily to our business.
Right, to our space.
And secondly, I'm watching the opportunity for distress. Now, it ain't time to pull the plug yet and go chase the deal, right? we're going to let the fire burn down a little bit, but believe me, we're going to show you that we're not negative on multifamily when the market is conducive.
Right.
So understand there's a play here. It's just not time to jump yet.
It's not time to jump in. That's exactly right. Water's still a little bit cold. And then we look at completions.
Now, at this point, all the people that hate hearing that, they've already hung up.
They've already hung up. Yeah, they're gone.
We can talk about everybody else, right? Okay.
But again, it's that money coming out of, if you can get out of a syndication and they're looking, people are looking, they're stressed. I mean, we see by the, guys like Warren Buffett and then, just individual Americans just piling that money, looking for a place to go with it. And again, we've still, 2024, Eddie, is still huge for completions, still another, almost 700,000 completions this year. And then we look at 2025 and then in 2026, it starts to drop a little.
Well, what happens is that it's a 2-year cycle.
Yeah.
So by the time they started this project, it was in 22 that they finished in 24.
Right.
So 25 was started in 23. So by the time they could read the problem, of this thing is going in the tank, then look at our added inventory of units this year. And by the way, the market doesn't need those.
No. Well, as we know, we talked about it last month. It's the B and C buildings that are suffering. Right. I mean, people are moving into the new stuff because they're incentivized to do so.
Well, they're just going to make the math work. They're going to give away free rent and free cable and free parking and whatever it is to make the math work. But it normally is a vacuum sucking people out of the older units is how it normally works in most cycles from the past.
That's it.
All right.
Let's talk about, I thought this was from the Altus Group, and this is the sentiment survey for the second quarter of this year. And Eddie, I just, I look here, and of course, green is the underpriced and black is the overpriced, and the blue. We look at retail, retail's not, it's holding up. Hospitality
did way better than came out of the virus thing, way better than people thought.
Absolutely.
No question about it.
But we look here, only 4% of the folks that were surveyed here said that they thought it was underpriced. And then you've got 56% say that, well, it's priced too high.
Yeah, when you look at multifamily and office and land, that tells you an optimistic seller that's hoping they're right and they're listing it, and it just the reality is this is what it looks like when you are in a real estate recession, and those asset classes are in a significant recession. And office is already had a crazy drop, but it's projected that that drop's maybe subsiding a little bit. Multifamily, the every prediction out there is the worst is yet to come. Yeah. Oh, well, not every prediction. I hear people that are promoters trying to go promote raising money. They say it's unbelievable time to get.
Depending on what you're what you're doing. Are you buying or are you selling? Right. It's like taking your car to the
dealership. To get in there right now, Joe. Yeah, that.
Well, and what we do have in office that we don't, that in multifamily, we've got all of this, continually being built, and then, office, they're not building, right? I mean, they've slowed down on that. So, yeah, multifamily is a little ways. We saw something the other day come through which says, I think it's bottomed out. Well, that was, we still got a ways to go.
All right.
Wall Street Journal. Office loans are toxic, but apartment loans are in bad shape. So, Eddie, it seems that back in 2021 and when rates were really low, that the way people were borrowing, right? So we could borrow from a bank, we could borrow from an insurance company, we could do these collateralized commercial real estate, collateralized debt loans. And, what they do is they were floating rates, and sometimes they were, there was no payments due, right? They were, not even interest only.
Yeah.
And so they forecasted, it was never going to change. The world was never going to change. The rent growths were too optimistic. And I thought this was important here. So even you strip out the costlier debt, right? 46% of commercial real estate collateralized loan obligation loans, these are, securitized, still aren't generating the net operating income, the NOI, that was baked into the loan underwriting when it was created.
It's just math.
It's just
right?
math.
And the math that was projected is not what this market is producing. And once again, they make reference to these vacancies, and the vacancy is going to increase because as you have more units on the market, you're like, I know the theory. I had a conversation with my wife the other day, and well, there's all these people that are moving in, and they're this and that and stuff. And I said, there is not the capacity. There is not the capacity. Like this is why the market is declining. Joe, rents are declining because of market pressure. It's called supply and demand. And somebody's going to holler calf rope and lower the rates. Now, Joe, in this same article, this paints a pretty good picture. Blue represents what's happening or what has happened. And orange is a projection of what they think is going to happen. And look at apartments. So the problem yet hasn't been that bad compared to where they see the market going. The only other asset class now, pretty dramatic with hotels, but office is already taken a whipping. I'm not saying there's not worse, but it's already taken a whipping. Industrial, which honestly most small investors are not invested in industrial. That's kind of Wall Street level money invested in that asset class. But apartments is where so many people are invested in these syndications. And Joe, we are monitoring this because this is where a lot of the people that are coming to us now are coming from, is they're coming from what they would have been invested in apartments. And now, not everybody agrees on this. Some people think it's awesome. Some people say my syndicator's wonderful. He's got it all figured out. But there is a lot of scared money chasing a new home right now, and that is because of charts.
And we see that every month. We see it every week, really, with the syndicators just took the wrong bet, right? So non-performing loans, Eddie. So why can't folks pay their mortgages, right? Reasons for 90-day delinquency. Well, there it is. Reduction of income, excessive obligations. We've seen credit card debts go up. We've seen, you're buying a car. All of that is the rates on automobile loans. And again, it's just people are stressed as far as the bills they have to pay.
Inflation and spending habits, right? People, all this consumer debt that shot up, right? A little bit because of unemployment, but this is not really that's 11%. But it's really people have less income. They have more month than they have money. And then they had some spending habits and they were out spending money like a drunken sailor. And then the government checks cut off, and all of a sudden then that's where you saw this consumer debt just shoot out of sight. And these are things that we could have easily predicted that were going to affect people's ability to pay their mortgage. Absolutely. All right, let's talk about trends in that.
Let's look at this. So we've got here's from Black Knight and Intercontinental Exchange, ICE, which owns Black Knight. So here are the four different categories. There's your GSE loans, which is the light blue down here, right? Then we've got portfolio loans. We've got FHA, and then we've got VA over here. Eddie, it looks like all of those are trending up as far as delinquencies.
Noticeably, the real tick up is FHA. But Joe, the truth of the matter is mortgage loans are not in like current delinquency is not like raging in any way.
Right.
And we're not seeing it in our business, right?
No.
We're not seeing the instance of somebody going into default is not more prevalent now than it was a year ago or a year and a half ago. So once again, you know, we're looking at the reasons for it. Consumer debt is not so much. Consumer debt delinquency is drastically going up. And so
yeah, let's look at the next slide, Eddie. I mean, here's the three different, right? We've got credit card debt in this aqua blue color. We've got the green here is auto loans, and then we've got mortgages. And you look at the, you know, the delinquencies as far as, well, we get all this in here, right, because of the Great Recession. And then, but we come over here and these lines are trending up.
Yeah, let me tell you, credit card debt running at 9%, that's a problem. You know,
And
auto
Eddie,
loans running at 8% delinquency, that is a big problem. Right. Mortgage rates trending at a tick over 3.
Yeah.
That is not a flag.
Right. It really isn't. It's kind of the new norm.
Well, I mean, look at the trend line.
Yeah.
Look at the trend line from 2000
kind of flat here, but look at that.
I'll go all the way back to 2015. I don't want to draw too many lines on here now. Just take mortgages. Go to 2015 and go forward and follow that line. And now you can see why I don't say we don't have a mortgage delinquency problem.
Right. And even in 2015, I mean, it was, you know, it was less, it was just a tick over 4%.
Yeah.
Yeah. And now
it was terrible. It was terrible in 2010, right? It was, well, 12% of everybody that had a mortgage was delinquent.
Yeah.
Right? But let me tell you something. That's why right now that we like our asset class.
We do. And Eddie, you know, the shocking thing, when I was doing some research yesterday, you know, the average interest rate on a credit card is 24 to 26%.
Yeah. Oh, the auto loans and
and they're 8%. You know,
that is raging. That is raging.
Yeah, it is. So Eddie, we see this last month. This number, the 1.926, was 1.873. The great chart that Black Knight that ICE usually has, they didn't have this month, but still the average days delinquency has gone up from 383, I think is what it was. And then it was 11, it was about a little over 1,000 days on the average days for delinquency on a foreclosure. And now it's ticked up to 1148. So
all right, let me get us nailed down on this chart.
Yeah.
Okay. Take your highlighter, Joe, and highlight the average days of 90 days delinquent plus. That's 436,000 loans. Okay. So, or excuse me, 90
days. That's
90
days.
Day plus loans. The average delinquency is 436 days.
Right.
Loans in foreclosure. That is 214,000 loans.
Right.
Of those 214,000 loans, the average days delinquent of those loans in that category is 1,148 days.
Yeah.
The issue with defaulted loans is not loans that are currently getting delinquent.
Right.
They are loans that have been delinquent for 3 years.
Right.
And that is the point that we keep making.
Right.
It is not that our current mortgage inventory is falling in the tank.
No.
These are back sins from way back.
Yep.
And they just haven't washed off the chart yet. And that is, and so that's why we say there's an opportunity with non-performing, is because this stuff, the mortgage banks are typically going to move these assets over into sell these into sales, and that's usually that's how we get to play for it, and that's where we think we're going. So
the number of, and again, you just take today and you minus 3 years off of it, Eddie, and then where do you end up with? You end up in 2021, right? Which is, we were, you know, that whole raging pandemic thing. So yeah,
that's it. All right.
So Eddie, different note cycles, right?
Yeah, right now, quite honestly, the note cycle for 2024 is that people are buying notes because of what your dollar buys. Right? If you're looking at buying a note and the cash flow it produces versus buying a rental and the cash flow it produces, the note is 2.5 to 5 times greater than the net income on a rent house.
There you go.
And this is where when people come hang out with us and they do these trainings and stuff, and we show them real charts and real numbers and stuff, it's not a shocker that our industry is growing when other industries are declining.
Right.
And it is because we are a different side of the market.
Right.
Right. When you have a rent house, you are very affected by inflation. When you have a rent house, you're very affected by mortgage rates. Right. And so all in rents are not raging up.
Right.
Expenses are still rising,
Yeah.
but rents are not rising. In fact, you've seen the charts on that. So that's why people are going where we're going. And this goes back to my saying, which is it's better to do the right thing at the perfect time than do the perfect thing in wrong time. Timing of the market is more important than what you do. Hitting the market timing is critical. And so we've hit a market pace of timing. So,
and Eddie, why does all this really matter that we've talked about today? I mean, I added that because I really wanted to get to that. And this is that chart we show you guys, right?
The amount of seller financing is increasing. The amount of note buying we're doing is increasing. All of these other turmoil things in the market and the availability of inventory of notes is already that truck's already loaded, so to speak. Right. It's not like, well, if rates drop, then all of a sudden these notes won't become available. There's nothing in the marketplace that tells us that. And so we're just a lot more blue than we used to be, which is our note side of the business. And
Eddie, we look at the number of notes. I mean, look at, and of course we just have, we're just into, 24, but we look at the number of notes that increased created that we could, gauge through our friends, Tracy and Fred, but it's gone up 30% between 22 and 23. And what do you think it's going to be this year?
I know that the amount of notes that we're seeing is a dramatic increase. Now, some of the notes we're seeing are already seasoned, so it's not just because they're making more notes.
Right. But
we are seeing the amount of notes we're bidding on is 4 to 5 times more than we were seeing a year and a half ago.
Right.
So is it all in the play of why we're saying this? Yes. We definitely are seeing trends in the market that we're just trying to show you what we're seeing. Residential values, properties getting sold, loan production. The banks are that thing's pretty much laid out.
Yeah.
The bank's problems are not fixing to go away because rates go down. The commercial real estate and particularly multifamily problems are not fixing to go away. So those are things that are kind of a market situation that pretty much it's already in motion. Mortgage lending, residential mortgage lending, and the housing market it's a little bit, the ball's out there. I mean, like, I'd say this, if you're watching a podcast and somebody assures you they got it figured out, if you send that to me, I'm dealing with some pretty smart guys that I'm asking what's going on in the market that invest $1 billion on a regular basis, and they don't know. They don't think they got it figured out. So I'd like to see that podcast if you see somebody that's got it totally nailed on the residential side.
Exactly. Eddie, yeah, a good update. We'll see how the rest of the year plays out. So, Eddie, we've got an event coming up November 8th and 9th. What is that? Have we done that before?
Yeah, this is our 13th year for Note Expo. This is the largest small investor discount note trade show in the country. And it is the event to be at. And if you're interested in this business at all, this is an event you got to go be a part of. You see the information there on your screen. And Joe, you guys did a great job of putting this together. We are watching the market. We are continually watching it through the end of the year. And by the time we get to Note Expo, we will have a lot of experts that are giving us clarity on stage about the market and where it's going and the best opportunities out there.
Absolutely. Guys, thanks so much for being with us. That wraps up another monthly update. We'll see you guys next week, same place, same time. Have a great week.